Welcome to Module 01 on mortgage lending. Today, we're focusing on adjustable and floating rate mortgage loans. These types of loans have interest rates that can change or vary over time, which directly affects your borrowing costs. Unlike fixed rate mortgages, where the interest stays the same, adjustable rate mortgages can fluctuate based on market conditions. Understanding how these rates move and what influences them is crucial for making informed decisions about your mortgage. We'll explore how these variable rates work, what the live rate context means, and how changes in rates can impact your payments throughout the life of the loan. Let's dive into the loan overview and get a clear picture of what to expect with adjustable and floating rate mortgages. In this slide, we're diving into the fundamental difference between fixed rate and adjustable rate mortgages. Let's start with fixed rate loans. With a fixed rate mortgage, your interest rate is locked in from the very beginning and stays the same throughout the entire life of the loan. This means your monthly principal and interest payments are predictable and won't change, providing stability and ease in budgeting. The trade-off, however, is that fixed rates usually start out higher compared to adjustable rate mortgages. On the other hand, adjustable rate mortgages, or ARMs, reset after an initial introductory period. Their interest rates can fluctuate over time based on market conditions. This means your monthly payments may go up or down as the rate changes. While ARMs often start with a lower rate, making them attractive initially, they come with the risk that your payments could increase later, which is something to carefully consider. Essentially, one payment path remains steady and scheduled, while the other adjusts to the market, reflecting these key differences. An adjustable rate mortgage, or ARM, starts off with a fixed interest rate for a set period of time. This initial phase often offers a lower fixed rate compared to a traditional fixed rate mortgage, making it an attractive option up front. However, after this initial period, the interest rate resets, meaning it changes periodically over the life of the loan. The new rate is determined by adding a lender's margin to an index, which reflects current market conditions. Because of these adjustments, your monthly payments can either rise or fall after each reset, depending on changes in the index. So, the key idea with an ARM is that it offers an initial fixed rate that eventually becomes variable, impacting your payment amounts over time. When it comes to determining ARM interest rates, it's important to understand that rate setting follows a clear formula rather than guesswork. The rate calculation involves three key components: the index, the margin, and the caps. The index acts as a market benchmark that fluctuates up or down based on market conditions, and it drives future interest rate changes. The margin is a fixed amount added by the lender, which is set in the loan terms, and usually remains constant throughout the loan. Caps play a critical role by limiting how much the rate can increase both at each adjustment and over the lifetime of the loan. This helps to reduce payment shock for borrowers by preventing sudden, drastic hikes in interest rates. To calculate your ARM rate, you start by adding the current index value to the margin, and then the caps are applied to keep the rate within certain limits. This rate then resets on a regular schedule, following these rules to ensure transparency and predictability. Let's talk about the index, which serves as a foundation for your adjustable rate mortgage, or ARM. The key idea here is that the benchmark rate moves first, and then your ARM adjusts accordingly based on the terms of your loan. There are several common indices used for ARMs. First, we have SLFR, which stands for the Secured Overnight Financing Rate. It's a market-based borrowing rate that many modern ARMs use as their base for rate resets. Next is the prime rate, which banks use as a reference. This rate is tied to broader economic interest conditions and is often used in variable lending. Lastly, there's a Treasury bill rate, a government short-term rate that can also serve as a benchmark for periodic mortgage adjustments. To calculate your note rate, we add a margin to the chosen index. So, the note rate equals the index plus the margin. Understanding how these indices work and their role in your ARM helps you grasp why your mortgage rate can fluctuate over time. Let's talk about the margin in mortgage lending. The margin is essentially the lender's fixed add-on to the index rate. This is a crucial point because, unlike the index, the margin does not change over the life of the loan. It remains constant, providing a stable component to the interest rate calculation. To give you an example, if the current index rate is 4% and the lender's margin is 2.25%, you add these together to get the new adjustable rate mortgage, or ARM, rate. So, for percent plus 2.25% equals a 6.25% ARM rate. Understanding this fixed margin helps in knowing how your mortgage interest rate can vary, but also which part remains steady throughout the loan period. Let's talk about ARM safeguards, specifically rate caps, which are essential features in adjustable rate mortgages. Rate caps are built-in limits designed to prevent your loan from repricing without any control or restraint. They essentially protect you from sudden, steep increases in your mortgage rate. There are three main types of caps to be aware of. First, the initial cap limits how much your rate can increase at the first adjustment, which is typically capped at about 2% above your starting rate. This means the very first time your interest rate changes, it won't jump dramatically beyond the set limit. Next, we have the periodic adjustment cap. This limits how much your rate can change with each subsequent adjustment, usually capped between 1% to 2% per period. So, with every adjustment after the first one, your rate can only increase within this range, helping to keep your payments more predictable. Finally, there's a lifetime cap, which sets the maximum total increase allowed over the life of the loan. Typically, this is around 5% to 6% above your original rate. While this cap cannot stop your payments from eventually increasing, it does set a clear maximum limit on how high your rate can go. It's important to remember that while these caps slow down the rate at which your payments might rise, they don't completely eliminate the risk of your payments increasing. So, they are a safeguard but not a guarantee against higher costs in the future. Here we're looking at the adjustment schedule for adjustable rate mortgages, or ARMs. The key to understanding these is the two numbers you see. The first number represents the fixed period, the time during which the interest rate stays the same, and the second number tells you how often the rate resets after that fixed period ends. Take the 3 to 1 ARM, for example. The rate is fixed for the first 3 years, shown here in black. Then, starting in year 4, marked in red, the rate can adjust annually. This option offers a lower initial payment, but the trade-off is that the rate risk begins sooner. Next, the 5 to 1 ARM gives you a fixed rate for 5 years before rates start adjusting every year. This is a middle ground with more initial stability before you face annual resets. Then there's a 7 to 1 ARM, which fixes a rate for 7 years before annual adjustments begin. This is often best for borrowers who expect to move or refinance before the reset occurs, minimizing risk altogether. It's important to schedule out the loan timeline first, so you understand when payments might change. Then, you can evaluate the payment risk that comes with those potential adjustments. This helps borrowers choose the ARM that best fits their financial plans and expectations. Here we have an example of an adjustable rate mortgage, or ARM, to illustrate how payments can increase significantly after the initial fixed period. This example assumes a $300,000 loan over 30 years with a 3-year fixed introductory rate. During the first 3 years, the interest rate remains steady at 4%, keeping monthly payments at $1,432. This is the stable payment period. However, once the fixed period ends, the interest rate adjusts, and so does the monthly payment. In year 4, the rate resets to 5.25%, causing the payment to jump by $225 to $1,657. Then in year 5, the rate rises again to 6.1%, pushing the payment up another $156 to $1,813, a total increase of $381 compared to the start. This example shows how payment shock can compound over time, making it critical for borrowers to understand the potential for rising monthly obligations after each reset in an ARM. Remember, the rates shown here are hypothetical for illustration purposes, but they highlight the importance of planning ahead when considering an adjustable rate loan. When we look at adjustable rate mortgages, or ARMs, the key reason borrowers choose them is often because they offer lower upfront costs and greater short-term flexibility compared to fixed-rate loans. This makes ARMs a great option for those who prioritize saving money in the early years of their mortgage or who anticipate moving or refinancing before the rates adjust. One of the biggest advantages is the lower initial interest rate. Typically, ARMs start with a rate that's below what you'd find in a fixed-rate mortgage, which means your early monthly payments can be significantly reduced. This lower introductory payment improves near-term affordability, and in many cases, it helps borrowers qualify for a larger loan amount. Another benefit is the potential savings for homeowners planning a short stay. If you expect to sell your home or refinance before the adjustable period kicks in, an ARM can be very cost effective, avoiding higher payments later on. Additionally, ARMs provide an opportunity to benefit if interest rates drop in the future. When rates reset, your payment could go down without the hassle of refinancing into a new loan. Lastly, the lower early payments of an ARM offer more cash flow flexibility. That extra money can be used for building savings, making home repairs, or supporting other financial goals during those initial years. Overall, ARMs can be a smart choice for certain borrowers who value these specific advantages. Now, let's discuss some of the key disadvantages and risks associated with adjustable rate mortgages or ARMs. While ARMs often start with lower initial rates, this can be misleading because future costs may be significantly higher. One major risk is payment shock. When a scheduled rate reset happens, your monthly payment can jump quickly, sometimes outpacing your household income. This creates high cash flow pressure, making it tough to manage your monthly budget. Another important point is interest rate uncertainty. Since your future payments depend on a fluctuating index, you never really know your long-term costs up front. This uncertainty leads to high forecast risk, complicating your ability to plan for savings, emergency funds, and other debts. Variable payments also contribute to ongoing financial pressure, as your budget can feel unstable and unpredictable. Many borrowers count on refinancing before a rate reset to avoid higher payments, but this isn't always a reliable exit. Changes in credit, home values, or market rates can close off that option. And finally, if interest rates rise and remain high, your ARM might end up costing more over time than traditional fixed rate mortgage, leading to a higher long-term expense. These are critical factors to weigh when considering an ARM. Let's talk about fixed rate mortgages, which are all about stability and predictability. With a fixed rate mortgage, the interest rate is locked in at the time you close a loan, and it stays the same throughout the entire term. This means your principal and interest payments remain consistent every month, which makes budgeting much more straightforward. Borrowers choosing a fixed rate mortgage accept that they won't benefit if rates drop, but in return, they gain the peace of mind that their payments won't increase if market rates go up. This certainty is the biggest advantage, supporting both affordability and long-term financial planning. Think of it this way. You have a stable payment for your home loan. So when you're reviewing your loan terms, you know exactly what your monthly costs will be. It's a locked-in rate that helps you manage your finances confidently. Let's take a closer look at the key differences between fixed and adjustable rate structures. With a fixed rate, your payment amount stays the same throughout the life of the loan, giving you stability and predictability. Typically, the initial rate tends to be higher compared to an adjustable rate. On the other hand, adjustable rates start lower, which can be attractive if you're aiming to save initially, but they can change after reset periods, meaning your payments might increase or decrease depending on market conditions. When it comes to long-term costs, fixed rates are generally more predictable since you know exactly what you'll pay over time. Adjustable rates, however, depend on future interest rates, so they carry some uncertainty. Fixed rates are straightforward and easy to understand, whereas adjustable rates involve more complexity with elements like caps, indexes, and margins to consider. Fixed rates are often best for long-term owners who want certainty and stability in their payments. Adjustable rates can be a good choice for buyers with shorter time horizons or those who expect market rates to decline. Essentially, the trade-off is between locking in a stable payment path with fixed rates or trading some certainty for potentially lower initial payments with adjustable rates. Here, we're looking at how a change in the interest rate impacts your mortgage payment. For a typical 30-year fixed mortgage with principal of $300,000, just a 1% increase in the interest rate can add nearly $200 to your monthly payment. Specifically, moving the rate from 6.00% to 7.00% raises the monthly principal and interest payment from about $1,799 to $1,996. That's an increase of $197 per month, which totals roughly $2,364 more each year. This illustrates how sensitive mortgage payments are to rate changes, and why even small shifts in rates can create a significant impact on your overall financial commitment. It's important to keep this in mind when considering how interest rate fluctuations might affect your budget. This slide focuses on payment shock scenarios under an adjustable rate mortgage, or ARM, specifically highlighting how the first rate adjustment can significantly impact your monthly payments, especially when your budget is already tight. We look at three cases here. In the first, a conservative increase of 1% raises the monthly payment from $1,850 during the introductory period to $2,020 after the first reset, which is an increase of $170 or about 9.2%. The second case shows a moderate increase of 2.5%, pushing the payment to $2,300, a $450 jump or 24.3% more than the initial amount. Finally, the aggressive increase scenario involves a 4% rate reset, which causes the monthly payment to rise dramatically by $800, reaching $2,650, a 43.2% increase. These examples clearly illustrate how crucial the first adjustment is because it sets the tone for your future payments. When your budget has little flexibility, even a modest rate rise can cause significant financial strain. Understanding these potential shocks can help you plan better and avoid unwelcome surprises down the road. Let's talk about when an adjustable rate mortgage, or ARM, makes sense. First, an ARM is a good fit if you plan to sell or refinance before the first big reset in your payments. This way, you avoid the risk of rising rates later on. Second, if you expect your income to increase over time, you'll be better positioned to handle any changes in your monthly payments, making an ARM a smart choice. Third, if you believe interest rates will stay flat or even fall during your ownership, an ARM can help you take advantage of those lower rates. Another important factor is having a financial cushion. If you have savings and the flexibility to handle potential payment shocks, the ARM fits well. The best use of an ARM is for a short-term plan combined with a strong financial cushion, since it's a punctual, not permanent, solution. This strategic fit helps you balance risk and opportunity when considering your mortgage options. Let's talk about when you should avoid an adjustable rate mortgage, or ARM. There are four key borrower conditions where the variability in payments can become a real liability. First, if you plan on owning your home long term, an ARM might not be the best choice, because after the initial low rate period, rate resets can happen, and if those rates go up, that early advantage can quickly disappear. Second, if you have a tight budget to begin with, even a small increase in your interest rate could cause a payment shock. That can put a lot of strain on your monthly cash flow. Third, if interest rates are expected to rise, an ARM becomes inherently riskier. The future rate adjustments could push your borrowing costs significantly higher, making it much more expensive over time. Finally, if your financial situation is unstable, meaning irregular income, limited savings, or uncertain employment, it's tough to handle higher payments or refinance if rates go up. In these cases, an ARM simply isn't suited to your circumstances. The key takeaway here is a transit board rule. Unstable payments require stable margins. If you don't have room in your budget or financial situation to absorb payment changes, steering clear of an ARM is the smarter choice. Here, we're focusing on the crucial role that credit and overall financial health play in qualifying for an adjustable rate mortgage, or ARM. The key idea is that ARM suitability really hinges on whether a borrower can handle potential changes in their payment amounts down the line. Let's break down the main factors that serve as underwriting signals or stability tests in this process. First is a credit score. A stronger credit score not only boosts the chances of getting approved, but can also lead to better pricing options. Next, we have the debt-to-income ratio. Keeping monthly obligations lower is important because it creates flexibility, leaving you room to comfortably manage any rate resets in the future. Finally, financial reserves are a critical element. Having cash savings acts like a safety cushion, providing resilience to absorb unexpected payment shocks or delays in refinancing. In essence, these reserves act as a key buffer, reducing risk for both the borrower and the lender. By evaluating these factors, credit score, debt-to-income ratio, and financial reserves, underwriters can determine how well an applicant fits with an ARM product, ensuring the mortgage terms align with their financial stability and capacity to handle future changes. This slide focuses on floating rate mortgages and how their rate structure differs from other variable loans, specifically adjustable rate mortgages or ARMs. The key point here is that floating rate loans have interest rates that move continuously with the market from the very start. There is no initial fixed period. This contrasts with ARMs, which typically begin with a fixed rate for some time before adjusting. A floating rate loan's interest rate is based on a lender's formula or a market link reference rate, and it can reset monthly, quarterly, or according to whatever schedule is specified in the loan agreement. This means the rate status is always live, constantly reflecting current market conditions. Because the interest rate can change at any reset period, payments can increase or decrease quickly. This introduces a significant degree of payment risk since borrowers must be prepared for fluctuations in their monthly mortgage amounts. In summary, floating rate loans adjust immediately and repeatedly with market changes, while ARMs have a scheduled adjustment after an initial fixed rate period. Understanding this distinction is crucial when evaluating different mortgage options and their associated risks. Here we're looking at the comparison between adjustable rate mortgages, or ARMs, and floating rate loans. Both fall under the broad category of variable rate structures, but they have some key differences that affect how borrowers experience changes in their interest rates. First, the adjustment cadence. ARMs reset their rates periodically, typically at set intervals after an initial fixed period. This means rate changes happen on predetermined dates, giving borrowers a bit of predictability. On the other hand, floating rate loans adjust continuously or very frequently. Their rates can change any time the underlying reference rate or lender's rate changes, causing the interest rate to fluctuate more dynamically. Next, rate determination. For ARMs, the new rate is calculated using an index plus a fixed margin set by the lender at each reset. This process anchors the rate to a benchmark while maintaining a consistent margin. Floating rates, in contrast, track the market or base rates more directly, reflecting immediate changes in those underlying rates without waiting for a reset period. When it comes to borrower risk, ARMs introduce payment shocks at reset points. Rate changes come in steps, which might be easier for borrowers to anticipate and prepare for. Floating rates, however, bring faster and potentially more frequent payment volatility, as rate increases can happen at any time, which some borrowers may find more challenging to manage. To summarize, when comparing these two, focus on the cadence of adjustments, the formula used to determine rates, and the associated borrower risk. Understanding these factors helps in choosing the right variable rate product that aligns with one's financial tolerance and goals. Let's talk about the rate environment and why it matters, especially for ARM borrowers. When interest rates cool down, borrowers with adjustable rate mortgages tend to benefit because their payments can decrease as rates drop. On the flip side, when the market is hot and borrowing costs rise, these borrowers face increased pressure as their payments reset higher. In a bull market, characterized by growth and tighter monetary policy, we typically see ARM resets pushing payments upward. This means borrowers need to be prepared for potentially higher costs. Conversely, in a bear market where economic activity slows and rates ease, future payments can be pulled down, offering some relief to borrowers. It's important to remember that economic conditions heavily influence both the index movement and how ARM resets occur. And finally, when planning or qualifying borrowers, the key rule is to qualify them based on the payment after the reset, not just the initial teaser rate. This helps ensure borrowers can comfortably manage their future payments regardless of rate changes. When planning long-term finances with an adjustable rate mortgage or ARM, it's crucial to prepare for the highest possible payment, not just the initial low rate that might seem appealing. First, model your budget assuming interest rates rise to the maximum adjustment cap rather than the current teaser rate, to understand your worst-case scenario. Next, build a cash buffer by keeping an emergency fund that can cover several months of higher mortgage payments. This provides a critical safety net. It's also important to stress test your income regularly, evaluating affordability in light of potential job changes, other debts, and upcoming expenses before each rate reset. Finally, keep a close eye on opportunities to refinance. By tracking your credit score, home equity, and market rates, you can ensure that refinancing remains a feasible exit route if your ARM becomes too costly. This structured approach helps maintain financial stability throughout the life of the loan. Let's talk about refinancing as your exit strategy, especially for ARM borrowers. When the risk of rising interest rates becomes significant, refinancing into a fixed rate loan can make sense, even if there are upfront costs involved. The goal is to lock in payment stability, exchanging uncertainty for predictable monthly payments, which makes budgeting much easier. You should watch closely for certain triggers, like when the reset date on your arm is approaching, the index rate is climbing, or you plan to stay in your home for the long term. These factors increase the likelihood of a payment shock, making refinancing a practical option. To decide whether refinancing is worthwhile, use the break-even test. This means dividing the refinancing costs by the monthly savings you'll gain. Only proceed if you expect to stay in a home long enough to surpass that break-even point. The best move for many ARM borrowers is to switch from an adjustable rate mortgage to a fixed rate loan. This strategy is most beneficial when future ARM resets are expected to push payment higher than the fees and costs of refinancing. Always consider fees, interest rates, your time horizon, and payment risk before making a timely decision. Refinancing wisely can provide peace of mind and financial stability. Before you agree to a variable rate or adjustable rate mortgage, it's crucial to fully understand the terms that will affect your future payments. Start by asking your lender what index is used, since this determines the base interest rate your loan will follow. Next, find out the margin, which is the additional percentage your lender adds on top of the index to set your actual rate. Make sure to ask about both the initial and lifetime caps. These caps limit how much your interest rate can increase at the first adjustment and over the life of the loan, respectively. Knowing when the first adjustment occurs will help you plan ahead financially. It's also important to understand how often your rate can reset after that initial adjustment, as frequent changes can affect your monthly budget. Finally, ask your lender to explain exactly how the new payment amount is calculated each time the rate adjusts. This will help you anticipate any changes and avoid surprises. Getting clear answers to these questions ensures you have a solid grasp of the variable rate loan terms and can make an informed decision. Here we have a real-world case study illustrating how an adjustable rate mortgage, or ARM, behaves in a rising interest rate environment. The borrower took out a $320,000 loan with a 5-to-1 ARM, which means the interest rate was fixed at a low 3.25% for the first 5 years. During this introductory fixed period, the monthly payment was stable at $1,393. Starting in year 6, the interest rate reset for the first time, jumping to 5.5%, which caused the monthly payment to increase by $383 to $1,776. Then, in year 7, the rate adjusted again, this time up to 6.75%, raising the monthly payment an additional $272, pushing it over $2,000. This illustrates the pressure that higher resets can place on household cash flow. While the initial payments were affordable, the substantial increases after the fixed period ended significantly raised the borrower's monthly financial obligations. The key takeaway here is that lower payments early on with an ARM can become much less affordable once rates start climbing, so it's crucial to plan for these potential increases. Let's review the key takeaways from this module on mortgage lending. First, adjustable rate mortgages, or ARMs, and floating rate loans reset over time based on an index plus a margin. This is important because it directly affects your payment amounts. Next, these loans often start with lower rates, which can make your payments more affordable in the short term. However, this advantage comes with a risk. Payments can increase later, sometimes significantly, which can lead to payment shock and complicate your financial planning. On the other hand, fixed-rate loans offer stability and predictability by keeping your payments the same throughout the loan term, though they trade off some flexibility to achieve this stability. These loans are generally best suited for borrowers planning shorter stays in a home, who have strong cash flow, and who are comfortable with staying aware of rate changes over time. Finally, it's critical to thoroughly understand the loan terms before committing. Pay close attention to the caps, index, margin, reset schedule, and the worst-case payment scenario to avoid surprises down the line. Keeping these points in mind will help you make informed decisions about mortgage options that best fit your financial situation and goals. When making a decision about an adjustable rate mortgage, or ARM, it's essential to follow a clear framework to ensure the choice aligns with your financial situation and goals. The first step is to run the sequence prioritizing stability first. This means assessing your financial stability by asking yourself, can your budget absorb the possibility of a higher payment down the line? This step is crucial because it sets the foundation for whether this type of loan is feasible for you. Next, evaluate your timeline. Consider how long you plan to stay in the home or keep the loan. Are you likely to move, refinance, or hold on to the mortgage for the long term? Understanding your loan horizon helps determine if an ARM suits your specific situation or if a fixed rate loan might be safer. Finally, compare rate scenarios by testing the best case, the expected case, and potential payment shock. This comparison helps you anticipate how changes in interest rates could affect your monthly payment and financial comfort. Remember, your decision should be driven by these factors: income, reserves, loan horizon, and monthly payment range, not just the current rate. Prioritize making the right decision before focusing solely on rate adjustments. This three-step test provides a structured approach to navigate the complexities of ARM decisions confidently.